Hello guys, investment research. You know, it's funny. When the market is hitting all-time highs, when everything feels great, that's exactly when we should be asking the tough questions. And the toughest question is this: am I ready for the next big crash? Because it's coming. So today, we're not just going to talk about how to survive the next market storm. No, we're going way deeper. We're going to explore two totally different philosophies for actually thriving in it. Are you a fortress or are you a rocket? Let's figure out which one you are.
All right, let's just get right to it. I want you to really think about this for a second. Could you personally log into your account, see that your portfolio has been cut almost in half, and then have the iron will to just wait for it to come back? Because this isn't some textbook hypothetical. This literally happened. A 48% crash. That was the reality for investors during the dot-com bubble burst. It's a real fear. And honestly, with all the hype and euphoria around AI right now, you can't blame people for drawing some uncomfortable parallels. So let's unpack this. So, to really answer that 48% question, we gotta understand the beast we're dealing with here. These massive market downturns, they aren't some once-in-a-lifetime freak accident. They are a regular, predictable feature of the investing world. They're part of the deal. So before we can even start talking about strategy, fortress or rocket, we have to look at the history. We need to see how often these things happen and just how bad the damage can be.
So just how regular are we talking? Well, take a look at this. Since 1955, the S&P 500 has gone through 12 official bear markets. And just so we're all on the same page, a bear market is a drop of at least 20% from a recent peak. 12 of them. That works out to a new bear showing up on average about every 6 years. Think about that. This isn't some black swan event. It's a normal part of the market cycle that every single long-term investor just has to be prepared for. It's not if, it's when. Okay, so we know they happen pretty regularly, but that's only half the story, right? What do they actually feel like? How bad does the bleeding get? And, maybe the most important question of all, how long does the pain actually last? We're about to look at the raw, unfiltered data for every single one of those 12 bear markets. This is the foundation for everything that comes next. All right, this table, this is where theory gets punched in the face by reality. Let's look at the averages down at the bottom first. The average bear market chops about 33% off the market's value, and it takes an average of 36 months, that's 3 full years, just to get back to even. But you know what they say about averages, right? They hide the extremes. And boy, are there extremes here. Look at those two monsters, back to back. March 2000, a 48% drop that took 87 months. That's over 7 years to recover from. And just when people thought it was safe to get back in the water, bam, October 2007 hits, a 57% collapse that took another 5.5 years to heal. That 1-2 punch was just uniquely brutal. And this quote just nails the psychological damage of that period. I mean, think about it. The S&P 500 had just clawed its way back from the dot-com implosion in the middle of 2007, and then it was immediately thrown into the wood chipper of the great financial crisis. It wasn't two separate events for investors. It felt like one long, drawn-out nightmare. Morningstar famously called it the lost decade. But honestly, as the source material points out here, that's putting it mildly. The reality was so much worse. 13 years. I just want you to let that number sink in. For 13 years, from the peak of the market in early 2000, it took until 2013 for the S&P 500 to finally and sustainably push past that old high. Can you imagine putting your hard-earned money into the market and seeing absolutely zero net growth for over a decade? If you were planning to retire in, say, 2008 or 2009, this was an absolute catastrophe. This is the risk we're talking about. This is the ghost of the lost decade that fuels this entire debate about how to manage a portfolio today. So, here we are. We're faced with this history, right? We know for a fact that downturns will happen. And we know there's a possibility, however remote, of a devastating decade-long financial winter. That reality leaves every investor with a fundamental choice to make. And that choice usually falls into one of two completely opposing camps, two totally different mindsets for how you deal with risk. The first is about building a fortress to protect everything you have. The other is about building a rocket ship to aim for the moon. All right, let's break down the first philosophy, the fortress. This strategy is 100% about capital preservation. The main goal here isn't to hit home runs or shoot the lights out with crazy returns. Nope. The goal is to make absolutely sure that when that inevitable storm finally hits, your financial house is left standing. It's a defensive strategy, all about prioritizing safety and stability over everything else. Now, within this fortress approach, there are really 3 main paths you can take.
First, you can sell for safety. This means getting out of stocks and moving into cash or short-term treasuries. This is for someone who absolutely cannot afford a major loss. Think of someone who's maybe 5 years from retirement. The second option is to stay for the long term. Now, this sounds aggressive, but it's actually a defensive play against your own emotions. It's for people with a long time horizon who know the market will come back, and their biggest enemy is their own impulse to panic sell at the absolute worst time. And then there's the third path, hedge for protection. This is sort of a middle ground, where you try to get some of the market's gains, but with an insurance policy against the big losses.
So what are these hedged products? Well, they're things like fixed index annuities, or FIAs, and a newer breed of structured ETFs. On the surface, they sound like the perfect solution, right? The best of both worlds. You get exposure to the stock market's growth, but they have a built-in floor, a guarantee that protects your principal from losses. But listen, there is no free lunch on Wall Street. The price you pay for that safety is a cap on your upside. So if the S&P 500 has a fantastic year and goes up 25%, your return might be capped at, say, 7% or maybe 10%. You're essentially trading away explosive growth in exchange for a good night's sleep. Okay, now let's do a complete 180. If the fortress is all about defense, strategy 2, the rocket, is pure, unadulterated offense. This philosophy isn't about just surviving the storm, it's about harnessing the storm's energy to achieve hypergrowth. This is for the investor whose main goal is to aggressively build wealth, and they're willing to strap in and embrace volatility to make it happen. The engine for the rocket strategy is something called a leveraged ETF. Let's use a popular one, SPXL, as our example. Now, this is not your grandpa's S&P 500 index fund. It's engineered using derivatives and debt to deliver 3 times the daily return of the S&P 500. So if the S&P goes up 1% today, SPXL aims to go up 3%. Sounds amazing, right? But, and you knew there was a but, and it's a huge one. If the S&P goes down 1%, SPXL goes down 3%. It's a double-edged sword that magnifies everything. Just buying and holding this thing long-term is basically financial suicide, because the drawdowns can be, well, they can be apocalyptic. But what if you didn't have to hold it through the bad times?
And that brings us to the system that tries to do exactly that. It's a dead simple 2-rule strategy that uses a classic technical indicator, the 200-day moving average. Think of it like a simple trend filter. The rules are brutally simple. Rule 1. When the S&P 500 index is trading above its 200-day average, the long-term trend is considered up. That's your green light. You're 100% in the rocket, SPXL. Rule 2. The moment the S&P 500 closes below that average, the trend is considered down. That's your red light. You hit the eject button and move everything to the safety of cash or short-term treasuries. The idea is to capture the big, powerful uptrends and sidestep the devastating crashes. It's all about discipline.
So, the billion-dollar question. Does this simple system actually work? Well, this back-tested chart tells a pretty incredible story. First, look at the bar on the far left. That's what happens if you just buy and hold SPXL since 2009, an insane 18,000% gain. But look at that drawdown, negative 94%. It would have been completely wiped out. Nobody, and I mean nobody, can emotionally handle that. Okay, now look at the far right. That's the plain old S&P 500, a very respectable 500% gain with a max drawdown of 34%. Now, look at the middle bar. That's our star, the 200-day rule strategy. It captured a mind-blowing 15,000% gain, almost all of the upside of this suicidal buy and hold strategy, but look at the risk. It's lashed the drawdown to just minus 35%. That's virtually the same risk profile as just owning the boring old S&P 500. So what this tells us is that this system delivered rocket-like returns, but with fortress-like risk management. Truly incredible. So let's just lay it all out, side by side. On one hand, you have the fortress. It's pure defense. Its goal is capital preservation. It's for conservative investors, people nearing retirement, anyone who prioritizes sleeping well at night. On the other hand, you have the rocket. It's pure offense. The goal is hypergrowth. It's for aggressive investors, people still building their wealth, who can stomach the volatility and have the discipline to follow a rules-based system. 2 completely different worlds. Okay, so we've looked at the brutal history of market crashes. We've laid out 2 fundamentally different playbooks for dealing with that risk. And that brings us to the most important part of this entire discussion. The spotlight now shifts from the market to you, because there is no single right answer here. There's only the answer that's right for your goals, your timeline, and your personality. So what are the questions you need to be asking yourself? First, what's your time horizon? How many years do you have until you need to start spending this money? The longer your timeline, the more risk you can afford to take. Second, your risk tolerance, and you have to be brutally honest with yourself here. Could you really watch your account drop by 35%, like in the rocket strategy, and not panic? If the answer is no, that strategy is not for you. Third, what are your goals? Are you trying to protect a nest egg you've already built, or are you trying to build one from the ground up? And finally, what's your temperament? Do you have the ice in your veins discipline to follow a mechanical system without second-guessing it? Or do you just prefer the simple peace of mind that comes from a defensive fortress?
And really, that's what it all boils down to. Because as we saw from the data, another storm is coming. It is not a question of if, it is only a question of when. And your success, your failure, your peace of mind as an investor, it's all going to be determined by whether the plan you chose before the storm hits actually aligns with who you are. So ask yourself, when the winds start to howl and the rain starts to fall, will you be hunkered down safely inside your fortress? Or will you be strapped into your rocket, ready to navigate the turbulence and soar even higher? The choice is yours.